All right, we are here. It is Friday, and as you know, on Friday we do a financial wrap-up with Mr. Michael Zuber. How are you, Michael?
I'm doing well, man. It's hard to believe it's April 1st, right? So everybody be careful. It's April Fool's Days. But more importantly, the first quarter is over. We are done with 3 months of the year. And I just want to ask all of you, do you have a buy box? Are you doing your daily discipline? Because as you will see in this conversation, a lot of things that we talk about on this channel are coming true. But more importantly, it likely means the real estate market's going to slow down. And it's going to give us investors an opportunity to do great deals. Only the informed, only the people that do the work will do the deals. Others will either overpay or frankly, probably not even be in the market. So get ready, do the work.
Do the work. I love it. And it's interesting. Buy box has been such a hot topic, and a lot of the people I talk to, and people are starting to really get it. Like, okay, let's get super focused. So let's get right into the news. Let's talk about this week, jobs. What happened this week in jobs?
So again, just this morning, we had our March job numbers reported. They came out at, I think it was 423,000. So a little bit lower than expectations. But we raised the numbers for the previous month. So net, very, very strong job market. In addition to that, unemployment rate went down, something called the U3. It went down to 3.6%. This is important because I put out on my YouTube channel under a brand new playlist called Whiteboard. I put out my predictions for 2022 and 2023 weeks ago. And this is the first step. I got it right. Unemployment's going to go down before it goes up. And in addition to that, wages went up. They're now up 5.6%. That, of course, is a national number. Wage inflation spiral is coming. It is what the Fed fears. It is why rates will be going up for the next 18 months or so. So at the end, the job market is strong. If you want to raise, go get one. If you want to change jobs, go do it. It is the best time to be an employee. You have all the power. If you're just starting out in your career, go get 6, 9, 12 months experience, change jobs. You will get a massive raise. So yeah, jobs are good. Jobs strong.
Jobs are strong. Good to hear. So let's talk about PCE. Explain what PCE is, first of all, and then let's talk about what happened this week.
Yeah, so PCE stands for personal consumption expenditures. Really, the only reason this is important is it is the Fed's favorite gauge of inflation, right? You and I probably talk about CPI, Consumer Price Index, because it affects our refrigerator, it affects our car. The Fed, a little more fancy. They use something called PCE. It came out hot. It came out highest since 1982 at 5.6%. It is a problem. And the reason it's a problem, because something I'm starting to talk about on my channel is the Fed being neutral. Not a lot of people know what that means, right? So the Fed to be neutral, it means that the Fed funds rate, the only rate that the Fed controls, the very, very front end, should equal inflation. Today, the Fed fund rate is about 0.37. Inflation, their gauge, 5.6. That tells you how much room they have to go. So get ready for higher rates. Will they take it all the way to 5.6? The hope is they don't have to, but eventually the Fed's got to be neutral. They are very, very accommodative today. And frankly, it's caused a lot of problems that are going to happen next year, including a recession that I see coming. So yeah, PCE is up. PCE is hot. The Fed is behind the curve. Expect a jumbo move in the Fed rate. On May 4th, should be 50 basis points. So it's coming.
You think 50 basis points?
Oh, absolutely. I think we go 50-50. I think we go 50 basis in May and 50 basis in June. So yeah, we're going to go up a full point in the next 2 meetings, in my opinion.
Wow. Okay. Wow. Well, I'm going to come back to that. So this is interesting. You've been calling this. We've been talking about this for the last year, especially the last 6 to 9 months. I'm going to come back to the rate hikes with the Fed. We're going to come back to it. Let's talk about wages again. So you talked about jobs. We opened with jobs. What are you seeing with wages, and then where are we going? What's happening there?
Wages are awesome, right? Because it helps individuals. However, wages are the largest contributor to inflation. And the biggest fear of the Fed is what happened in the 1970s. It's called a wage inflation spiral. Basically, where everybody makes more money, it makes everything more expensive, and thus they need to pay more than it. And eventually you get to this Paul Volcker moment where inflation is running at 14%. He's got to take the Fed funds rate to 18% to crush it, crushing demand. And that's what the Fed fears. And I think it is already occurring. And if the Fed doesn't get in front of it, it could be really, really bad. So what I would tell you to do in 2022 is go get that raise. Because again, wages are typically sticky. They don't go down. So yeah, go get it. But wages are up. 5.6% is the highest in my lifetime, at least in my adult lifetime. And it might grow into a bigger problem. So we've got to watch it.
There's a lot going on in the economy, a lot to watch. Pay attention, folks. Michael's doing the work. Thank you, Michael, for doing the work. Let's talk about yield curve. Explain what a yield curve is and explain kind of the news and what's happened this week and what's being talked about.
Yeah. So the yield curve, what is it first? So typically speaking, the yield curve is steep. What does that really mean? Well, it's really a simple equation, right? If I were to come to you, Ty, and borrow money, and again, borrow, not give, right? Because I'm sure you'd give me money if I needed it. But let's say I'm going to borrow money. You would probably charge me less if I was going to borrow the money for 30 days, if I was going to borrow it for 30 years, right? You're out on the risk curve, right? If you're going to tie Ty's money up for 30 years, Ty, rightly so, would want a higher rate than if it was 30 days, right? So in most environments, a healthy yield curve is steep. Short-term money, less expensive than long-term money. Simple concept, right? Well, sometimes people get spooked. And sometimes they actually believe that the Federal Reserve will lower rates in the future and raise rates near term. So we happen to be in an environment where the 2-year borrowing money for 2 years is more expensive than borrowing money at 10 years. We are also currently borrowing money at 5 years, which is more expensive than borrowing money at 30 years. This is not a sign of a healthy economy. This is a sign of an economy that is at best confused and at worst geared up to a recession. Because it's been a pretty good indicator since 1955. A yield curve inversion on the 2 and 10s has correctly predicted a recession every time, somewhere between 9 and 15 months, right? It's a leading indicator. And it's been right a lot. Is it the perfect indicator? No, of course not. Nothing is in economics. But it's one of those things that gets your attention because it logically doesn't make sense. Why should it be cheaper for me to borrow 10-year money than 2-year money? It shouldn't sit right with you. And thus, when the bond market flashes that kind of yellow or red flag, it certainly gets my attention. Like, what is going on? What is broken? What is not operating appropriately? And as of yesterday, it happened. So pay attention.
Pay attention, folks. We are in a shifting time economically. Pay attention. What did you see this week with pre-approvals?
Well, the beauty of my channel, One Rental at a Time, is I talk to experts, and a couple of them are in the lending space, both traditional mom and pop, Matt the Mortgage Guy on Wednesdays, and non-QM lenders, Convoy and Velocity. And they're all telling me that rates have gone up so much that any pre-approval written in the last, any pre-approval that's more than 2 weeks old is useless. Rates are moving fast. And they're probably going to keep moving fast because not only do we have monster Fed moves coming up, but we also have the Fed selling instead of buying mortgage-backed securities. So not only could the short end or the front end go up, but the long end could go up. It's going to be messy. So if you are a homeowner, if you are a real estate agent, you have clients with pre-approval letters that are 30 days old, do yourself and them a favor. Strongly recommend they ping their real estate broker because rates could be up 0.5 point. I talked to one of my non-QM lenders, and in a 10-week period, I guess 11 weeks now, 11-week period, rates are up 250 basis points. That is from 4.5 to 7. 7% money. Fixed for 30 years, sure. But the last time I saw 7% 30-year money was like 2006, 2007. But it's here. And again, as investors, cost of money shouldn't bother you because if you're following what I talk about, we only do great deals. But still, that'll make you pucker up, right? 7% money when you're used to 4% money. good news. We got to do the math. We got a mortgage payment, cost of capital, cost of money. So probably going to pay less. So yeah, yeah, pre-approvals, be careful. I'm also seeing some mortgage brokers. I talked about this about 90 days ago, like the better.coms and these online body houses. Be careful. They're not doing the due diligence on pre-approvals. They're just trying to put as many fish in or many poles in the water. And I've actually had a couple of people reach out to me saying they went that route and they couldn't close and they wasted thousands of dollars, right? The appraisal and inspections when they never should have, because the pre-approval was not worth it. So if you're going to go do just a traditional mortgage, FHA, conventional, I love Matt, the mortgage guy. I talk to him every Wednesday. He has a playlist on my channel. I would check him out.
100%. I would agree. You cannot, I think always it should be a localized business. You should be dealing with an actual person to person.
Yeah.
Yeah.
Agreed.
Versus these big mills. It works when interest rates are low and you get away with it. Yeah. But it's so true, Michael. So true. You get a pre-approval and they're not really checking all of the different conditions. You think you're approved and then surprise at the end. So let me ask you, and this is a two-part question and it's a follow-up from how we started.
Mm-hmm.
Interest rates.
Yep.
So let's talk about in terms of interest rates going forward, right? And how will that equate? Where do you see the 30-year mortgage moving in the next 3 to 6 months, 12 months, based on what the Fed has to do, based on the current cycle of what we're seeing change? Where do you see that? It
would not shock me at all if we actually have a 30-year owner-occupied mortgage with a 6 on it sometime this year. We started the year with a 2, I think. Certainly a 3. So we get our 30-year money at 6%. That is going to do 2 things. One thing people expect, and the second thing no one expects except me, and I'm already talking about it. So number one, you take 30-year money from 3% to 6%, you have what is called demand destruction. Less people are qualified. Simple, right? People get that. Unfortunately, we've had 2 years of record low interest rate. The Fed kept rates too low for too long. Now we have a 2-year window tie where 70% of residential loans have a 2 or a 3 on it. So we are going to have supply destruction, which nobody sees coming except me. We're going to have less people list. We're going to have less move-up buyers. We're going to have less flippers. We're going to see transactions go from 6.7, which is existing in new, down to something with a 4 on it, maybe 4.8, 4.9. Just think about the ripple of impacts of that. We're going to have less cash out refi. We're going to have less money swashing around the system. We're going to have less commission paid to real estate agents. We're going to have less mortgage money. All of these things are coming. If you're not building side hustles or a portfolio of rentals that can get you through the lean times, get ready for a second job because it's coming.
You heard it here, folks. It's time. It's time. We got to do the work. Now is the time. I want to just circle back something we said pre-roll about a great deal, a good deal versus a great deal. And something we were talking about interest rates pre-roll before we started recording about the timing of, 4% money, 7% money. And you made a bold statement, which I love, that everybody should hear. What did you say?
Yeah, I think what we're referring to, the fact is, I don't care what the cost of money is. I would gladly pay 10%, right? If the prevailing 30-year money was at 10%, I would still do as many deals as I was going to do before. But that's because I do the work. I know that in my market with 10% money, I would need a 14 or 15%. I always want my yield above the cost of money. I want a great deal every time. I will do them. And what does that mean, right? If we had 10% 30-year money, I would have to do 14 or 15%. Because I want the yield higher. It would mean I have to pay less, or rents would go up, or some combination. Investors that do the work will do just as many deals. We will only do great deals. We don't do bad deals. If you call yourself a real estate investor and you're not doing the work, you're just writing offers because you got money in your pocket, you're going to go broke. You're going to do bad deals. You're going to do alligators. You're going to do 1 or 2 and never do any more. People that follow what I talk about, that do the work, that adjust when cost of capital goes up, we're going to keep going because we only do great deals and we adjust with the market. And then here's the deal. I've been doing this a long time. Let's just snap our fingers and say we have 30-year money at 10% for 2 years, just pretending. Guess what happens in 2025 or 2026 or 2027? The United States economy goes through another recession, and the Federal Reserve wants to get us out. So they will slash rates. And then bingo bango in 2028, I do a refinance, no cash out, just straight up rate and term. I take my 10% money to 6% money, my cash flow explodes. I recycle capital, I stay engaged, I do what's right for my portfolio. Only do great deals, do the work every day. This is the best time. A flat market is when investors shine, and I am so looking forward to it.
I love it. You heard it here, folks. Do the work. We're not doing good deals. We're doing great deals. Every day is a great day to do a great deal. Doesn't matter the cost of capital. You heard it here. And by the way, creative financing, seller financing is coming right now. I was talking pre-roll with Michael about a deal. Money's a little bit expensive. And then we said, why don't you just do a blended rate? Take the first subject to at 3% and then offer the guy 7%. It gives you a blended rate of about 4.5, 4.25, 3/4, somewhere in that range. So folks, today is a great day to do a great deal. Thank you, Michael, for all that you share. I just want to encourage folks, get the books, one rental at a time, conversations with, I did that backwards. One rental at a time. It's funny because the mirror effect. One rental at a time, conversations with millionaires. Thank you so much, Michael. Appreciate all that you do.
Thanks, bud. Take care.